Okay. Good morning, everyone. Good morning. Today we start one of the most important sets of your standards in financial reporting paper, that is financial instruments. Okay. To give you an idea of the importance, you can expect on an average about 15 to 20 marks coming in from this paper. You do financial instruments and you do another standard that deals with consolidation, reporting, business combinations. That set of standards, about 4 to 5 standards, and financial instruments, these 3 standards. All in all, these 2 sets of standards will be coming for approximately 40 to 45 marks in your financial reporting paper. So extremely important standards. And your attention, your what you can say, your time and your focus is naturally required for this particular topic. Okay, so with this background, we start with our topic, financial instruments. All in all, we will be covering 3 standards here. That is Ind AS 32, that deals with the presentation aspects, Ind AS 107, that deals with the disclosure aspects. But the most important one is Ind AS 109, that is actually based on financial instruments. Okay, so these are the key standards which we will be discussing in our deliberations over the next 10 days. Okay, so now why did we have a separate standard on financial instruments? Okay, what was the reason these standards had to come out? And why have they made it a little bit complicated? Okay, see, I was also thinking that the standards are very complicated, which they definitely are. But for your understanding, what is there in your syllabus, we'll try to simplify and make it as easy to understand for your comprehension. Okay, so before Ind AS regime, okay, before Ind AS, your financial instruments were largely confined to something known as investments. Okay, so whenever you used to make an investment in a share or in a bond or in a debenture or whatever investments, in a fixed deposit, whatever it is. Okay, so these investments, all of them would go and sit under the reporting standard of AS 13. So these would have your reporting requirements. And what AS 13 said? Well, AS 13 gave you the options to recognize your investments as current investments or non-current investments. So this was what was the classification there. Very simple classification, no change. So what was the measurement principles? Well, non-current investments, if you recollect, they would be measured at cost. Simple, straightforward, no worries. It would be measured at cost with a permanent diminution in value. If there is a permanent reduction, diminution in value, would be recognized. So this was how you would do the accounting. As far as the current investments were concerned, these were recognized at cost or market value, whichever is lower. So these were the principles which by and large we were following to in recording the investments under AS 13. Now, what is the problem that we foresee here, or why we had to have financial instruments coming in the play? Okay, what had happened was, you remember the subprime crisis that happened in the United States? The aftermath of that was the reporting standards on financial instruments. See, these standards were also there globally, and these standards were also there in the United States. Okay, so when the subprime crisis had happened, nobody foresaw what could be the impact on banks, financial institutions, etc. Banks, financial institutions gave loans. They made loans to borrowers. Okay, and when the borrowers crashed, the obvious impact was that the bank's balance sheet started to get affected. But there was a problem with the bank's balance sheets. The banks had made loans which were largely non-current in nature, so they were recognized at cost in line with the accounting requirements at that point of time. So when this was the scenario, because of the fall in the borrower's credibility, the bonds or the loans risks naturally multiplied manifold. But this was not reflected in the financial statements of the banks and the financial institutions. As a result, when the borrower's credit ratings, when the borrower's credibility went down, there was no corresponding impact on the reporting of the loans given to the borrowers in the books of the financial institutions because we had to record it at cost. And this led to a massive bloodbath in the markets, and ultimately a slew of changes came into force. And that gave the birth to a comprehensive reporting on financial instruments. So now we do not have AS regime, at least for the listed entities and the turnover thresholds. Because of that reason, we have now come to a new regime, that is financial instruments. What is the radical change that came about because of this? Well, you would have always studied that Ind AS is a fair value based standard. And here, this is the place where you will see maximum applicability of this definition. All your financial instruments typically will be stated at fair value. We have moved from a historical cost model. See, AS 13 non-current investments measured at cost implied that it was a historical cost model. But the financial instruments market is extremely dynamic in nature. And that is why we have moved from a cost model based on historical prices to a fair value model based on current price movements. And that is what the financial instrument standards have sought to achieve. That does not take away all the loopholes from the erstwhile regime. There are still some deficiencies here and there, but this has moved to a more realistic accounting. As we go further, you can see that we do not look at only current and non-current classifications. Even if you have made a long-term investments, say in an equity share, which we will be studying later, whatever be the fair value movements have to be recorded in your financial statements. So even if it is more than cost, yes. Do not stick to the principles of conservatism anymore. And I think I have told this repeated number of times earlier as well. Conservatism is no longer a fundamental principle of your conceptual framework. Conservatism is an enhancing characteristic, but what is important is achieving realism in your presentations. And that is what we have tried to achieve by getting these new standards. Okay. So now, how will this session progress? We will be starting today's class and maybe the next class with a largely theoretical discussion on what are my financial instruments. We will see the definitions of financial instruments, financial assets, financial liabilities, equity. We will see a couple of examples, couple of illustrations from your study module. And then we will move on to the further complicated sums like off-market transactions. Then you move on to convertibles, and then you move on to derivatives accounting and all that. Okay. So today's class, at least for today, I'm sure it will be largely a theory session. Okay. So I will be taking you through your own study module. So I hope that you have the study modules in front of you. Okay. We will be referring the study mat. I will also give you examples, which if you want, you can take a screenshot, and then we will do illustrations, questions, etc. from past exams, from RTPs, MTPs, whatever is there. Okay. So let us start our discussion on what do we mean by a financial instrument. Okay. Good morning, Viraj. Good morning, Kaushiki. Good morning, Shriram. Good morning. Okay. So what is a financial instrument? What is a financial instrument? This is the first part of our discussion. And this is a fairly simple part. This is a very simple part. A financial instrument is one that gives rise to a financial asset. That gives rise to a financial asset for one entity and gives rise to a financial liability or equity for another entity. So both the conditions have to be satisfied. When you have two parties entering into a transaction, entering into a contractual bond, entering into a contractual relationship, this contract should give rise to a financial instrument to a financial asset for, say, entity A, and the same contract will give a corresponding financial liability or equity recognition for, say, entity B. So when both these things are happening, it meets the definition of a financial instrument. Okay, so now coming back to, now we have to obviously understand ki bhai, what is a financial asset, what is a financial liability, and what is an equity. And these definitions should stay with you for life. Okay, these definitions should stay with you for life. They are some of the most beautiful definitions that you can see in the entire standards. And for your information, the financial instrument standard, the bare standard itself runs into nearly 300 to 350 pages. It is a bulk standard. Okay. So now let us come to the definition on financial assets. We now first discuss financial assets. Then we move on to financial liabilities. Then we again come back to financial assets. There are 3 to 4 legs in each definition. I will not do all the legs together because I want the progress to be slow and gradual. We'll do for asset, then we can see corresponding liability, then we do something else, then we come back to the definition. That's how we'll be moving. So financial assets, the definition says that financial asset, one second. Yes. Financial asset is any asset that is cash. So till now, all that we saw was cash is a mode of exchange. Cash is a mode of exchanging in order to get goods or services. Even under the earlier standards, what we did not have a separate classification for cash. Cash was just defined as cash and cash equivalents in AS3. We still have that part under Ind AS 7. But cash in itself, where does it fit? See, if you open your trial balance and look at all the line items which are there, if you want perfection in reporting, each and every item in the trial balance should have a corresponding standard that describes how do I fit, into which standard do I fit, what will be the recognition principles, derecognition principles, measurement principles, as well as disclosures. So each and every line item of the trial balance should have a standard attached to it that discusses on the reporting. Till now, cash, we only had something that dealt with the reporting in the cash flow statement, but there was no standard attributable to cash. So now here for the first time you have cash which is coming in as a financial asset. Okay. The next one is investment in equity shares. Investment in equity shares. Okay. So it could be cash, it could be investment in equity shares. The standard typically words it as financial asset could be an equity instrument, could be an equity instrument. So I will not stick to shares. Let us slightly improvise now. We can say that it could be an equity instrument of, okay, I'll just fill in the blanks later on. Okay, investment in equity shares of, in equity instruments of. Okay, see, cash flow statement talks about presenting the flows that happen in the cash. Cash per se did not have any reporting standard for it. So now we have Ind AS 109 that includes cash as a part of the financial assets. Okay, so now I want you to answer, when we talk about financial assets in terms of an equity instrument, when we talk about financial assets in terms of an equity instrument, will it be my own equity, investing in my own equity, or will it be investment in equity instruments of other entities? Will it be my own shares that I am investing in, or will it be equity shares of other entities that I am investing in? Just a simple question. Okay. What is it going to be? What is it going to be? Obviously, investment in equity instruments of other entities, of other entities. Okay. Why other entities? Why not my own entities? Well, investment in own entities typically amounts to a buyback. Okay, you will have to extinguish it within 7 days or 10 days or whatever be the requirements. So basically, when you invest in your own shares, it would lead to a reduction in your equity share capital. It would lead to a reduction in your equity share capital, the paid up capital, and hence it will not amount to a financial asset. Okay, you are not going to get money elsewhere. So therefore, this is not going to be your own equity investments. It will be investments in the equity instruments of other entities. Okay, so this is the second part of the definition. Both are clear. So I will not prefer you to use these words, investment in equity shares. I will not want you to use these terms henceforth. Henceforth, you will be using the terms investment in the equity instrument of other entities. Okay, investment in equity instruments of other entities. Okay, and then we move on to the third part. Okay, it is a contractual right. A contractual right. Okay, a contractual right for what? It is a contractual right to receive cash. A contractual right to receive cash or another financial asset. It is a contractual right to receive cash or another financial asset. So these are your financial assets, third leg of the definition. So can I say that receive cash or another financial asset means it is including a right where I get this from another entity, or I get another financial asset from the other entity? And what could be the financial asset? This financial asset could again be cash, equity instruments, contractual right, etc., etc., what we are going to see now. So can I say that financial asset definition itself includes the right to receive another financial asset? Yes or no? So this is like a chain which is getting created. It is a contractual right to receive cash, fair enough, but it is also a right to receive another financial asset. That means this financial asset could mean cash, which is already covered separately, equity instrument of another entity, or whatever is there. Okay, you will be having subsequent legs of the definition. So this is like a chain transaction which is getting created. No problem. Okay, so this is what is your next part of the definition. We will cover one by one all the parts. Okay, I'm not going to take you through the independent definition immediately. Okay, so now coming back to your study material. Okay, we are discussing what is a financial asset. Just a second. I don't want to multi. Okay, we are discussing what is a financial asset. We have covered the first part. It is cash. Okay, we have covered the second part. It is an equity instrument of another entity. We have covered the third part, first leg of the definition. It is a contractual right to receive cash or another financial asset from another entity. Okay, so it is a contractual right to receive cash. So the gamut of this financial assets has expanded a lot because of this part of the definition, because of C1 of the definition on financial assets. Why and how has it expanded? Well, you have a right to receive cash from whom? Let us assume you have sold goods to somebody on credit. So obviously the sale of goods requires you to get the money in future at some point of time. Yes or no? So when you make a credit sale, that credit sale is giving rise to a right to receive cash. And because it is giving right to receive cash, it will mean that the trade receivable, which till now did not have a specified standard. Under the accounting standard regime, trade receivables did not have a defined standard of its own. How did I report trade receivables? Well, sir, I would use generally accepted accounting principles, and I would do the accounting. Debit the receiver, credit the giver. And that was what I used to pass the entry. And it would be a receivable, but there was no standard to prescribe trade receivables reporting. Now that is covered under Ind AS 109 when we talk about a contractual right to receive cash. So Janvi is right that all your monetary assets means which are determinable cash amounts, receivable in cash, they would fall under the definition of financial assets. Okay, so this is the first part of our definitions. Okay, don't worry about the remaining parts. We'll be covering it with examples and then I will visit this. Okay, now you will help me. I'm not shifting the page. I do not want you to shift the page. I want you to tell me, based on the discussion that we had till now, can I define what is a financial liability? Make an attempt. Can I define what is a financial liability? Ignore the remaining parts. We'll not discuss that right now. We will discuss it in the course of the examples that we will be having today. Okay. So when I talk about financial liability, it is just opposites. Okay. Do I have an opposite of cash as far as a liability is concerned? Answer is no. So this will not be there in the financial liabilities definition. Equity instrument cannot be, I have equity shares, I issue equity instruments, but will it amount to a liability? Answer is no, because it goes under equity. So we have three financial instruments, which is there in the definition of financial instrument itself. It could be financial asset for another entity. Correspondingly, it should be a financial liability or equity of another entity. So if it is the right to receive, if the asset is an equity instrument of another entity, for the other entity, it will become equity and not financial liability. So this is not going to come here. Whereas when we talk about contractual right to receive cash, opposite of it is possible here. It becomes a contractual obligation. Opposite of right is an obligation. It is a contractual obligation to receive cash. No, it will be a contractual obligation to deliver cash, to pay cash. So it will be a contractual obligation to deliver cash or another financial asset. Or another financial asset. So this is the first part of our financial liability definition. This is the first part of our financial liability definition. It will not have a corresponding cash. It will not have a corresponding equity for financial asset, but it will have a corresponding contractual obligation to deliver cash or other financial assets to other entities. Is it okay? Contractual right, contractual obligation, is it clear? If you want, we can quickly move to the definition on financial liability, and here it is. A financial liability is any liability that is a contractual obligation to deliver cash or other financial asset to another entity. So this is the first part of our definition. Is it clear now? Yes. So far, is it clear? So far, is it okay, everyone? Yes. Any doubts? Any doubts? No doubts? No doubts? Okay. All right. Now we move on to some examples. Do not look at your study module, please. It's not advised. Okay. I want you to think and give me the answers. Okay. Think. It will take some time, but or you may be wrong also. That is also perfectly fine. But I now need you to think and answer. Okay. Financial assets. I'm not coming to equity, and I still have a lot of discussion on the definition left. Okay. No, there is no difference between payment of cash and delivering cash. It is the same. But see, the wordings used is deliver cash because it has to fit in with, they have used the term deliver and not pay, because you can deliver cash and you can deliver a financial asset, but you cannot pay the cash and you cannot pay a financial asset. A financial asset is not something which you pay. A financial asset is something which you deliver. Okay, so that is why they have preferred to use the term deliver only, so that it covers both cash as well as a financial asset. Okay, payment is strictly related to cash. You cannot pay a financial asset, so they chose the word deliver. Okay, all right. So now let us look at certain examples. Okay. First one, trade receivables. Will it come under financial assets? Answer is yes. So the corresponding opposite is trade payables. Will it come under financial liabilities? Obviously, yes, because this is an obligation to deliver cash. Okay. Bills receivable. Will it be a financial asset? Bills receivable. Will it be a financial asset? You have studied bills receivable, right? So it is an instrument. So is it going to be a financial asset? Is it going to be a financial asset? Bills receivable. Bills receivable. Yes. A bills receivable is a contractual right that gives you it is a paper that gives you the right to receive cash at some time in the future. So bills receivable becomes a financial asset. Similarly, bills payable, will it be a financial asset? Obviously, bills payable will be a financial liability. Bills payable will be a financial liability. Outstanding expenses. Outstanding expenses. Will it be a financial liability? Outstanding expenses. Will it be a financial liability? Yes, contractual right to receive cash. That's right. It is a financial asset. The right to receive cash or cash equivalent is already established. Okay, Sriram. The right to it is already, when you sell goods and you give a bills receivable, the right to receive cash is already established. Okay, so that itself will be a financial asset. Okay, outstanding expenses. Yes, yes. See, please participate, because I need you guys to participate so that the fundamentals get strong. Okay, so outstanding expenses, yes, they are financial liabilities. Why? Because they represent an obligation to deliver cash. They represent an obligation to deliver cash. Sir, तो फिर outstanding expenses, so we are playing opposite na? So we will put prepaid expenses also here. You tell me, will prepaid expenses be financial assets? Will prepaid expenses, see, outstanding का opposite क्या हो गया? Prepaid हो गया ना? So we are talking about financial assets and financial liabilities. So since both of them are opposites, do you think this is correct? Outstanding expenses is a financial liability. I agree with you. What about prepaid expenses? What about prepaid expenses? What about prepaid expenses? That's right, Sriram. That's right. What about prepaid? Prepaid expenses. Think about the nature of the asset. You will get the answer. Yes. Okay, I need some more answers. Kaushiki, that's right. Yes, Namrata is also right. Anybody else? Shriram, Janvi, Panu, Viraj. Prepaid expenses. Prepaid expenses cannot be a financial asset. Prepaid expenses cannot be a financial asset. Sir, why? See, today I enter into a contract. I mean, I pay the insurance of my factory today. Today is what? 13th May. This insurance is for a period of 1 year. So when I pay the amount today, every month I will book the expense for my financial reporting on a monthly basis. Yes or no? I will be paying it I will be booking the expense today. When I make the payment for insurance, I will make the full amount. Let us say 1,200 rupees. But each month the expense of 100 rupees will be shifted to the profit and loss, assuming you are reporting on a monthly basis, or assuming you are reporting on an annual basis. Out of 1,200 till March, you would have completed 10 months. So you will be booking only 1,000 rupees as expense. 200 rupees will be the prepaid expense balance sitting in your ledger on 31st March 2024. Against this 200, are you going to receive cash? No, sir. वो cash नहीं मिलेगा आपने को. Are you going to receive another financial asset? Answer is no, sir. You are not going to get. Then what are you going to get? You are going to get a service against this. Sir, what service? You are going to get indemnified if there is any loss like fire, theft, etc. in your factory. You are going to be indemnified for that loss, and that indemnification which happens to you is not going to be that service that is being provided to you is that of an indemnification. See, you cannot say that, sir, insurance company to humko cash dega. Insurance company will give you the cash only if you suffer a loss. What the insurance contract does is it gives you the service of insurance for that period. It's not giving you cash. Sir, loss ho gaya to, the insurance receivable amount will be a financial asset at that point of time. If you have a loss and the insurance company admits the claim, then what it has admitted, that will be a financial asset when the loss has actually happened. But until you do not get until there is a loss, there is no obligation to deliver cash for the insurance company. And because there is no obligation to deliver cash, you cannot go to the insurance company and say, give me the money. Arey, where is the loss you have suffered? You don't have a loss. Then what is the company giving? It is giving you the insurance protection for that period. And that protection is not a financial asset. That protection is not a financial asset. And therefore, the contractual right to receive does not exist in a prepaid expense. The contractual right to receive does not exist in a prepaid expense. Okay. You will be getting a service of protection in the future, but you are not going to get the service. You are not going to get cash or a financial asset or whatever is covered. So therefore, prepaid expenses not there. Namrata, I'm not going to say that the right should be unconditional. I'm not going to say that. Okay, but you look at the contract words. In the words of the contract, what would be written? Sir, it would be written that the insurance company agrees to indemnify against earthquake, tsunami, fire, burglary, robbery, except acts of terrorism, waging war against the nation, intentional losses, etc., etc., vagara, vagara, everything is written in that. So therefore, the insurance contract does not, see, I'm not just discounting the fact that it should be unconditional, because we come to certain future examples in just a couple of minutes where there could be a conditional obligation and still it will be classified as a financial instrument. Okay. So now, prepaid expenses, everybody understood. There is a contractual right to receive service, agreed. But what service are you going to get? You are going to, so the contract looks something like this. You have the company, you have the insurance company. Okay. This is the reporting company. When the reporting company pays premium, do you think insurance company is obligated to pay cash? Contract padho, contract mein kya likha rehta hai? See, suppose you take a life insurance premium. Can you say, I have taken the premium, give the sum assured to me? See, I'm not talking about money back policies again. I'm talking about a normal life insurance, a term insurance plan. In the life insurance, is it a financial asset for you who are insuring yourself? Answer is no, it's not. Because you are never going to get cash back. You will get cash only when you cease to exist. So therefore, it cannot be a financial asset. It cannot be a financial asset. There is a significant event that has to happen there. Okay, that does not mean I talk about unconditional acceptance of cash. I'm not talking that also. But here, what is being covered by the insurance company is the right to indemnify. The right to indemnify. Insurance company is being obligated to indemnify. Obligated to indemnify. So for the reporting company, it is getting a right to be indemnified. By whom? By the insurance entity. What is the insurance company incurring? It is incurring an obligation to indemnify. It is incurring an obligation to indemnify. If in the period, ना कोई tsunami आया, ना कोई earthquake आया, there is no fire, there is no burglary, nothing has happened, will the insurance company pay you cash? No. Arey, forget cash. Will it even reimburse you for the premium? Answer is no. जाकर पूछ के देखो, you ask your end, can you tell LIC, see, I did not die, so please give me the money back. अरे will it give the money back? Answer is no. You have taken factory insurance. आपके फैक्ट्री में कुछ दुखद घटना हुई नहीं, nothing happened in your factory. Can you go to the insurance company and say, see, I paid you the premium, but nothing happened in my factory. I did not raise a claim. Can I get the premium amount back? Answer is no. Gone is gone. That is, in fact, the premium is the compensation that the insurance company is taking for the risk that it is assuming. Are you able to follow? The premium is a consideration that the insurance company is taking for the risk that it is assuming. That is why the premium will never be equal to the amount of the loss that you will be suffering. If that is the case, nobody would go to insurance companies, right? If you have a factory worth 10 crores, do you think premium will be 10 crores? ऐसा थोड़ी होता है. You cannot have premium worth 10 crores. फिर वो क्या हो गया? फिर you will obviously tell, so why should I take insurance? If I have to pay equal to the amount of my factory value, then I might as well not take the insurance. Insurance premium will be a small amount compared to the assets which you are insuring. But why that is taken? For the potential risk that the insurance company is assuming. सबसे थोड़ा premium it collects. And then suppose किसी एक factory में आग लग गई. In one factory there was a fire. Then all these premiums which it has collected will be a cash corpus for that insurance company that it will utilize to pay off. That is a separate part under IRDA regulations. But this is how the insurance mechanism works. So the contract between the reporting company and the insurance company is merely a contract where there is a right of indemnification. There is an obligation of indemnification. There is no cash that is going to be exchanged in this contract until the event occurs. And after the event occurs, there will be inspection, there will be survey, there will be assessment, there will be a salvage, and then you determine the value. And once that is agreed by the insurance company, at that point of time, it becomes a financial asset. What? The amount the insurance company has agreed to pay. That agreed amount becomes a financial asset. Is it okay? Yes. So prepaid cannot be. So Sriram, I hope it's clear to you. Okay. So now let us move on to the next one. Advance paid towards goods or services. Is it a financial asset? Is it a financial asset? Is it a financial asset? Bolo. You have paid advance for goods or for services. Is it a financial asset? Answer is no. Look at the definition of financial asset. What is it? It is a contractual right. Right for what? Right to receive cash. Cash मिल रहा है आपको? No. It is a right to receive another financial asset. मतलब cash or another financial asset. So financial asset में you have cash, you have equity instrument of another entity, and then 2-3 things are there. Those 2-3 things also you will not be getting. What are you going to get? Sir, either I'm going to get goods or I'm going to get services. I'm going to either get goods or I'm going to get services. Both of them are not financial assets. Both of them are not financial assets. And therefore, will advance towards goods or services fit the definition? No. So therefore, this cannot be a financial asset. This cannot be a financial asset. Okay. Are you going to get the feeling of it now? So now, what will be the opposite of advance towards goods or services? Unbilled or unearned revenue. Unbilled or unearned revenue. That is basically income received in advance. Basically income received in advance. Do you think that unbilled revenue or unearned revenue, is it a financial liability? Answer is obviously no. Why? Because here, once you collect the cash, you do not have the obligation to deliver cash. You are having obligation to deliver the service or the goods for which you have collected the advance. So therefore, the obligation is to deliver services or to deliver goods, but not to deliver a financial asset, but not to deliver cash. And therefore, unbilled or unearned revenue, which we commonly call as income earned in advance, income received in advance, it is not a financial liability. It is not a financial liability. Is it okay? Yes, all clear? Okay. Next. Gold. Do you think gold is a financial asset? Do you think gold is a financial asset? Come on, tell me. Do you think gold is a financial asset? Gold bars, gold coins, gold biscuits. Legitimate, not illegitimate. Legitimately, आप अपने balance sheet में दिखाते हो because you have made investment. Company like Tanishq will have quite an amount of gold bars, gold biscuits, whatever. Is it a financial asset? Is it a financial asset? Obviously, it's not. Gold is nearly is convertible to cash, and you get a fair value also. But that does not take away the fact that it does not meet the definition of a financial asset. क्या है financial asset? It is cash, equity instrument, or contractual right to receive cash. Okay, so that won't come here. Okay, gold ka obviously opposite will not be there. Okay, so we move on to the next one. Income tax payable. Income tax, that's right, Viraj, that's right. Income tax payable. Okay, what do you think? I'll add others also here only. Yes. Statutory dues, income tax payable, GST payable, customs duty payable. Okay, so Kaushiki, Janvi are on the same page. Yes. Viraj also is on the same page. Basically, all your statutory dues. Okay. All these are payable in cash. All these are payable in cash. So Namrata, Viraj, Janvi, Kaushiki, Shriram, what do you think? Okay, so Shriram is also saying that it will be a financial liability. Okay, fine. All of you have said it is a financial liability, which made my job very simple because all of you are not right. Okay, doesn't matter. I want this to happen because then only we understand. Okay, so look at the words contractual. This is more important than anything else. Contractual. Okay. What do you mean by contractual? Contractual का मतलब क्या होता है? Contractual. means arising by virtue of a contract. Arising by virtue of a contract. And contract में क्या होता है? There is an offer, there is an acceptance. There is an offer and there is an acceptance. So you have made an offer, somebody accepts the offer, then there is a consideration. Agreed? So this is the normal flow of a contract. Written है ऐसा जरूरी नहीं है. Contractual है, that is necessary. So it's not necessary to have it in writing, but it is necessary to have it. As a contractual obligation. In income tax, have you entered into an offer with that government saying that, see, this is the income I'm earning. This is what is my offer. ठीक है, you made the offer. 30% of that. Let us assume, in your words, आपने offer दे दिया. Government has accepted. But is it a voluntary offer that you have made, or is it a statutory imposition on you? Are you able to follow the difference? See, in a contract, in a contractual obligation, it is merely giving rise to right and obligation to the other parties out of their own will. Out of their own, out of their own will, it happens voluntarily by both of them when two parties come together. In the case of a statute, did you go to the government and sign a contract? No, sir, aapne to bola no need to write also. Agreed. So when there is no need to write also, did this come into, is this amount payable because you agreed something with the government, or pe dhyan do, is this amount payable because it is imposed upon you, because it is thrust upon you, because it is forced upon you? Why are you paying this? Are you paying income tax? Are you paying GST? Are you paying customs duty? Because of a contract or because of a statute? The words are different. The impositions are different. The meanings are different. Are you paying by virtue of a contract, or are you paying by virtue of a statute, by virtue of a law, by virtue of an act? Why are you paying this? You are paying it not by virtue of a contract. You are paying it by virtue of a statute, by virtue of a legal obligation, by virtue of something imposed upon you, by virtue of something forced upon you. That is what you are paying. And chalo, let us even assume कि आपने pay कर दिया. Consideration क्या मिला आपको? What is the see, when you pay something, you are paying something. If it is a contract, बदले में कुछ आना चाहिए ना. There has to be something in return that flows from the government to you. What flows to you, the taxpayer? What flows to you? You will say, sir, हमारे tax के पैसे से सड़क बन रहे हैं, and then you have infrastructure development that is happening, and then you are having what you can say, there is growth of the nation, there is growth of everything. वो सब तो ठीक है. All of that is fine. But what are you getting out of tax payment? For a contract, it is you give something, you get something. That is what is the meaning of contract, right? You give something, an offer, and there is an acceptance, there is a consideration, then there is a counter there is a counter receipt of goods or services. In a tax payable, you know what is the income tax you have paid. Yes. So can you go to the government and say, look, I have earned 1 lakh rupees. I paid you 30,000 rupees. So 30,000 ke equivalent, give me something. Will the government give you something equivalent to 30,000? Zyada se zyada, if it is a good government, they will call you, they will give you a certificate saying that bronze or silver or gold or whatever it is. Abhi to wo bhi आपके इनकम टैक्स पोर्टल पे डाल देते हैं. आपको सर्टिफिकेट फिजिकली नहीं मिलता है. एंड दैट इज द ओनली थिंग दैट दे कैन डू. Nothing else will be done. There is no offer and acceptance between the government and the entity. It is not an agreement. It is an imposition. Agreement hota, would you be willing just tell me, are you willingly paying 30% or are you forcefully paying 30%? Keep aside sentiments. Keep aside sentiments. Think from purely a business perspective. Are you paying 30% because you want to or because you have been made to? Because it is forced upon you, because it is legally imposed upon you. Sriram, tell me, why are you paying income tax? Why are you paying GST? Why are you paying customs duty? From a purely business perspective, why are you paying? You are paying because it is a statutory imposition on you. It is a forceful payment which is made, and therefore though it is payable in cash. अच्छा एक बात बताओ, आपने दे दिया एंड बात खत्म हो गई? अरे ऐसा भी तो नहीं होता है. They have the rights to open your assessments for 6 years. They have the rights to come do search and seizure at your premises whenever they want. So what are you paying for? What are you paying for? आप क्यों पेमेंट कर रहे हो? It's a mandate. That is why you are paying. It's not a contract. It's not a contract. It's a mandate. There is a difference between a mandate and a contract. A contract has an offer and an acceptance. A statute has an imposition and a compliance. These are the biggest differences between the contract and the statute. Statute is imposed and there is a compliance. Contract has an offer and there is an acceptance. Offer and statute cannot be compared with each other. Likewise, compliance and acceptance cannot be compared with each other. So law has an imposition with a corresponding compliance. Contract, on the other hand, has an offer and an acceptance. In these cases, the law, therefore, you cannot say that law and contract are equal. They are not equal, because neither consideration hota hai, nor is there an offer, nor is there an acceptance. Therefore, even if it is payable in cash, it cannot be a financial liability. It cannot be a financial liability because the words are very, very clear. The words are very, very clear. It is a contractual obligation. The obligation must stem. The obligation must arise. The obligation must be born out of a contract. Out of a contract. Is it okay? Yes. Are you clear? Any doubts? No doubts? Any doubts? No doubts? Okay. All clear, everyone, so far? Yes? Okay, fine. So now let us move on to the next part. We take another couple of examples. Investment in equity shares of another entity. Is it a financial asset? Answer is yes. Sir, क्यों? अरे definition में तो लिखा है financial asset is cash, is equity instrument of another entity, and therefore equity shares of another entity which you have invested in, obviously it will be a financial asset. It will be a financial asset. Okay, fine. All right, let us move on to the next one. Debentures issued. Debentures issued. Debentures give you an obligation to pay interest as a contract. Debenture is a contract. याद रखो, debenture एक contract है. The person subscribing to the debentures is giving a consideration. In exchange of that, what is he getting? He is getting a stream of interest flows for the next couple of years, and then the principal also will come back to him. So debenture is a contract. Debenture is not a statutory imposition. So debenture issued, may the entity is having an obligation to deliver cash in the form of interest as well as the principal, and therefore debentures become financial liabilities. Okay, fine. 7. Investment in equity shares. Can I say investment in of investment in debentures of another entity? Investment in debentures of another entity. Can you say that this is also a financial asset? Huh, sir. Because if there is a contractual obligation to deliver cash in the form of interest and principal, then for the entity investing, it is a contractual right to receive cash in the form of interest as well as return of principal. So therefore, in both the cases, there is a contract to pay or receive interest as well as principal. So therefore, investment in debentures also will become a financial asset for the entity. Is it okay? Yes. So ye clear ho gaya. All right. Now we come to something interesting. Okay. We are still in that part of the definition. हमारी सुई अभी तक उसी definition में अटकी पड़ी है. Contractual right to receive cash, contractual obligation to deliver cash. We have still not moved 1 cent, 1 inch, 1 centimeter beyond that. Okay. Now, I'll take you through a couple of cases more so that this gets embedded in your minds. Okay. Financial asset, financial liabilities. How many ho gaya? 6 are done. Right. Okay. Now, think and answer. Think and answer. You are coming from an intermediate background. No problem. Everybody does. Okay. Now, suppose an entity issues 10% cumulative redeemable preference shares. You tell me, see, basic of equity, you know. Okay, so I have not yet discussed equity, but that is fine. But basic of equity, you know, equity share hai. Okay, monies will go at the time of liquidation, blah, 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 blah. All that is what you are aware of. I'll come to equity in a short while. But now you tell me 10% cumulative redeemable preference share. What is it? Is it equity or is it a liability? Is it equity or is it a liability? Come on, tell me. Is there a contract when the entity comes out with an issue of preference shares? Is there a contract? Answer is yes, there is a contract. So now I need you to tell me this. Will it be a part of your equity share capital or will it be a financial liability? Yes, Janvi is right. Namrata is right. What about the others? What you have learned in your intermediate under accounting standards. See, Ind AS is not difficult. Ind AS appears difficult because we have learned something and we are now unlearning it. We have learned something and we are now unlearning it. Okay. So the unlearning process is a little time consuming. That is the only thing. Otherwise, all of you can easily, master these topics. Okay. So yes, everybody is right. Purnima, Kaushiki, Shriram, Namrata, Viraj, what about you, my friend? What about Panu, Behra? What do you think? Yes, everybody gave the right answer. cumulative redeemable preference shares. It is an obligation to deliver cash in the form of what? In the form of dividend, as well as in the form of dividend, as well as in the form of principal. You have to repay it, and it will be repaid before winding up. It will be repaid definitely. मतलब winding up के बारे में तो सोचो ही मत. Okay. So it is an obligation to deliver cash, and therefore, henceforth, take the balance sheet of any company which has preference shares. You will find that it is going and sitting under financial liabilities. It is not going and sitting under equity shares. That is why, if you remember, we used to calculate something known as gearing ratio. Gearing ratio में क्या करते थे हम? What we used to do? We used to take preference shares as debt, and then we used to do the accounting. We used to do the calculation. Why? Because the balance sheet structure at that point of time was such that preference share capital would go under equity shares. Whereas in fact it wasn't. In your intermediate आपने पढ़ा होगा equity share capital. On top you first write preference shares. उसके नीचे you write equity shares. Preference shares get preference at the time of settlement over the equity shareholders. All these things you would have studied. And therefore, that you have to forget. This you will now have to fit it in your mind. So cumulative redeemable preference shares are obviously what you can say financial liabilities. Likewise, investment in cumulative redeemable preference shares. Investment in cumulative redeemable preference shares. 7. Okay. Acha, which brings us to the next part. In Inter CA, this was shown as equity. Under Ind AS, this becomes a financial liability. Because this was shown as equity, what did you do with a preference dividend? Preference dividend shown as appropriation. याद करो कहां दिखाते थे? You would show it in the P&L appropriation account. But now preference dividend will be shown as finance cost. That means it will form a part of the profit and loss. Earlier case, the preference dividend did not form a part of profit and loss, but now it will form a part of profit and loss. So you are having your net profit after tax. In that you will already have preference dividend. So नाम में क्या रखा है? नाम तो कुछ भी दे दो. Look at the nature of the instrument. The nature of the instrument requires you to mandatorily pay the dividend, and it also requires you to redeem the principal. अरे भाई नाम आपने preference share दिया है, but वो preference share जैसा कुछ है ही नहीं उसमें. There is nothing on it, and because there is nothing, no feature of equity, how can I show it as equity? You give whatever name you want. I don't really care about the name. What I care about is the feature of the cash flows. Are you obligated to pay the dividend? Yes. So discretion कहाँ हो गया? अरे equity में do you have the obligation to pay the dividend or the discretion to pay the dividend? Sir, वहाँ तो discretion है. It's not obligatory. A shareholder cannot come and hold me to ransom and say you did not give me the dividend. Now I'm going to sue you for my money. You cannot say that in the case of an equity instrument. But yes, in the case of a preference share where there is a contractual obligation to deliver dividend, but वो dividend नहीं है, it is actually in the nature of interest, and that is why it will now be moving to finance cost in the P&L and not to P&L appropriation or retained earnings as it was done earlier, Is it okay? Yes. Another aspect, amalgamation, purchase consideration, payments made to preference shareholders was regarded as a part of purchase consideration. Now, Ind AS 103, business combination, payments made to preference shareholders, not a part of purchase consideration because preference shareholders hai hi nahi. Their instrument does not evidence a single feature of equity. It is entirely liability in nature. It is entirely liability in nature, and therefore payments made to preference shareholders in a business combination under Ind AS 103 will not form part of purchase consideration. Will not form part of purchase consideration. Okay. Absolutely right. When you are preparing financial statements as per AS, okay, don't use the term GAAP. Even I use it sometimes, which is not right. You cannot use the term GAAP or IGAP or Indian GAAP because it is a misleading term. Okay, it is a misleading term. You will have to use the term under the AS regime. When you prepare the financial statements, you will be preparing it by showing preference shares as a part of capital. Whereas under the Ind AS regime, you will have to show it as a financial liability. Absolutely right. Not only that, my friend, you will, under the AS regime, you will be showing the dividends paid in the P&L appropriation. Whereas under the Ind AS regime, the dividend that accumulates is going to be a part of your interest cost, which will be hitting the profit and loss. AS regime, preference dividend never hit the profit and loss. Okay. So that is the change which you will now be witnessing. That is the change which you will now be witnessing. Okay. So I think that covers quite a bit of our examples. Okay. Lawsuit pending. Suppose you have entered into a contract and there is allegedly, I'm not saying there is, I'm saying that there is an allegation, there is a accusation that there is a breach of contract, and now the case has gone to the court. There is a lawsuit which is there, and in that event, you will have to pay the amount if you are at fault, or you will receive the amount if the counterparty is at fault. So a lawsuit which is pending, is it a financial liability or not? Think and answer. Think and answer. A lawsuit which is pending. A lawsuit which is pending. Is it a financial liability? Ultimately, the settlement will happen in cash only. But is it a financial liability or is it a non-financial liability? Okay, contingent, all right. That is okay, contingent is fine, but I need you to tell me whether it will be a financial liability or otherwise. It is not a contractual obligation. Absolutely right. See, if it was part of the statute, you agreed, counterparty agreed, why would you file a lawsuit? You filed a lawsuit because you believe the contract is worded this way. The counterparty believes otherwise. And that is why there is a dispute. And then there is a supposed breach of contract by one of the parties. You are unable to decide who is at fault. And therefore, you have gone to the court of law to help in disposing of this issue. So now all the hands everything is in the hands of the court's judgment. So there is no contractual obligation here. Court ka order aa gaya, you have to pay the cash. That is pursuant to a court order, not pursuant to a contractual obligation. And therefore, if there is a pending lawsuit, it will be a statutory obligation, not a contractual one. So it is not going to be a financial liability. Absolutely right. Absolutely right. Okay. All right. Now let us come to the next part. Financial guarantees. Financial guarantees. Okay. Jio wants 5,000 crores loan. उसका नेटवर्थ शायद उतना नहीं होगा. I'm just making it up. Okay. Jio wants a 5,000 crore loan, but उसका नेटवर्थ उतना नहीं होगा. So what it goes to a bank and asks. Bank says you do not have that kind of net worth or turnover. We cannot finance you. Then Jio will tell, but my parent has. I will tell my parent to give a guarantee that in case Jio is unable to pay, Reliance will pay it off. So Reliance signs the guarantee contract. Okay. That in the event of a default by Jio, Reliance will pay off the amount. Now I need you to tell whether the financial guarantee that is given by Reliance, will it be a financial liability or not? Will it be a financial liability or not? I'll give you a hint. Read the definition of financial liability, that one line only, very carefully. That one line only, very carefully. You will get your answer. Okay, Kaushiki gave the answer, which is right. Panu is saying, Panu also gave the answer. Okay. That Sriram also gave the answer. Purnima gave the answer. Yes, it is a financial liability. It is a financial liability. And then those of you who don't agree will immediately jump up and say, but kidhar hai, obligation kidhar hai? Look at the words. It is a contractual obligation to deliver cash or a financial asset. That's it. Am I right? Anything else in the definition? Yes. To deliver cash or other financial asset to another entity. Have they used the words unconditional? Have they used the words unconditional? Answer is no. वो किधर भी लिखा नहीं है. Is financial guarantee a contract? Yes, it is a contract. Reliance will actually sign a guarantee contract that in case Jio fails to pay, I will make the payment. So there is a contractual obligation. What is the obligation? Reliance will repay the loan if Jio fails to do it. So there is a contractual obligation to deliver cash. To whom? Is it delivering to Jio? No, it is delivering to the bank, to another entity. So therefore, there is a contractual obligation to deliver cash to another entity. So therefore, it is a financial liability. But sir, it is contingent. Agreed, it is contingent. That is why when we do the accounting for financial guarantees, we will do it at fair value. And that accounting will be based on the estimate of the contingent event likely to happen or not. And whatever movement is there in the fair value, we will take that also into account. But merely saying that it is contingent and putting it in a disclosure and not accounting for it would amount to not giving a true and fair view of your liabilities position. So financial guarantee is a financial liability. It is a financial liability. Okay. It is a financial liability. All right. Okay. Next, salary advance. Is it a financial asset? Answer is no. Salary advance क्या होता है? You pay the money and you recover through service from the employee. You pay the money and you recover through service from the employee. Since you are recovering the service and not cash, since you are recovering service and not cash, it is going to be just an advance, not a financial asset, not a financial asset. Okay. All right. Security deposit. In a lease contract. Security deposit. Security deposit in a lease arrangement. Come on, tell me. Security deposit in a lease contract. When you enter into a contract, you are going to pay a deposit. Okay. 2 months rent, 3 months rent, 5 months rent, 6 months rent. इतना आप देते हो. So now I want you to tell me, is it going to be a financial asset? Just answer security deposit. I'll come back to the financial guarantee later on. Okay. Security deposit in a lease contract. Is it going to be a financial asset or not? Panu gave the right answer. What about the others? Namrata, Purnima, Viraj, Shriram, Janvi. Yes. Janvi is right. Janvi is right. What about the others? What do you think about financial? What do you think about security deposits? Yes, it is a financial asset because ultimately at the end of the lease tenure, if you don't want to extend it, then you will get the security deposit refund back into your account. It is a contractual right to receive cash. It is a contractual right to receive cash. Okay. All right. We've covered quite a number of cases. 10 warranties or performance guarantees. Okay. Warranties, security deposit is a financial asset. That's right. Okay. All right. Warranties or performance guarantee. Warranty means what? You have purchased, let us assume an air conditioner, and then 1 साल तक उसका कुछ भी repairs, maintenance, etc., whatever is there, that is going to be free non-chargeable. Okay. Performance guarantee, if your device is spoiled, you will get a replacement. Okay. So this is a performance guarantee. The other is a warranty. So now tell me, do you think warranties or financial or performance guarantees, are they financial liabilities or not? Do you think they are financial? Do you think they are financial liabilities? Warranties, performance guarantee. Warranty means this is related to repairs. Performance guarantee is related to replacement. Is it a financial liability? Okay. Let me put it like this. You purchase a car from Maruti. Okay. How do I word it for you? so that you can tell me. Those of you who did not give the answer I want, I'm not yet telling the answer. Just think of it and then let us understand. So there is A Limited. A Limited purchases a car from B Limited. B Limited is basically a dealer in Maruti cars. Okay, B Limited is basically a dealer in Maruti cars. B Limited purchases the vehicle from Maruti Limited originally. Okay, so now what has happened is B Limited sells the vehicle to A with a 2-year warranty. That if anything happens, the materials, whatever spares, whatever is there, we will be repairing it without any charges. Okay. So A Limited took the car and went. Now the paint started fading from the car of A Limited, which he had newly purchased within 6 months. Paint started fading. So A Limited came to B Limited and said that, look, my paint is fading. I'm still within the warranty period. You will have to do something about it. Do something about it. What B Limited will do? What B Limited will do? B Limited. What is the contract? Contract is of warranty. So now I want you to tell me, understand, will B Limited paint the car? Or will B Limited paint the car free of cost? Number one, paint free of cost. Or will B Limited pay cash? What do you think B Limited will do as part of the warranty? A Limited took the car, paint started fading, took it to the, okay. So I got the answer. Yes. Who was it? Panu, tell me. What do you think? What B Limited will do? Will it give cash? No. Namrata is right. Kaushiki is right. B is not going to give cash. It is a warranty contract. Warranty contract में cash नहीं चलता है. Warranty cash में free service चलता है. It is the free service which will be done. You will not pay cash at all. So for B Limited, this does not represent an obligation to deliver cash. It represents an obligation to deliver services. That too free of cost. Do you think B actually does it free of cost? No, B will have a corresponding contract with Maruti. कि ऐसा ऐसा होगा, then I will have to do the services free of cost. And for that, you will have to compensate me. That is a separate agreement which can be examined later. Right now, I am concerned with this contract. This guarantee contract, this warranty contract. It is an obligation to deliver free paint services. Free paint services. Is it a financial liability? Answer is no. So therefore, warranties will not come under financial liabilities. Similarly, you purchase a phone as per the performance guarantee. साल के अंदर कुछ हो जाता है. Then you get a replacement of the phone. The replacement of the phone is not going to be a financial asset because phone is not a financial asset. And because phone is not a financial asset, performance guarantee also cannot be a financial liability. Cannot be a financial liability. Okay. Last example. Last example. Okay. Last example, an entity has a practice of paying Diwali bonus. Okay. Diwali bonus to employees. It's not obligatory. I repeat, it is not the statutory bonus. It is a Diwali bonus which is paid to employees additionally. Okay. And this has been happening since the last 25 years. The company is in existence since 25 years. Every year it has been paying Diwali bonus. 1 month salary it credits extra. Okay. Since the last 25 years, yehi chal raha hai. This is what is going on. Okay. such that the Diwali bonus has created an expectation in employees कि दिवाली बोनस तो यार आना ही आना है, दिवाली बोनस विल कम इनटू पिक्चर, सो हमको तो पैसा मिलेगा ही मिलेगा. इट इज नाउ गोइंग टू गो अगेंस्ट द मैनेजमेंट. व्हाट स्टार्टेड ऑफ एज a gesture of goodwill, the employees are now viewing it as an expectation as their right. Now I want you to tell me, payment of Diwali bonus, not the statutory bonus, payment of Diwali bonus, is it going to be a financial liability? Think and answer. Think and answer. This is not the statutory bonus. This is a practice which was being followed. It is a 25-year practice which has created expectation in employees' mind. You tell me, will this be a financial liability or not? Okay. Okay. Let me just help you with two things. Look at the definition of financial liability, number one. Second one is, if you join this entity today, think and answer this question to yourself. Are you in a position to claim the Diwali bonus? Or is the company within its right to deny the Diwali bonus for you? Okay. So answer this question. Think yourself like this. Read the definition of financial liability. Second part, what you do is, if you are an employee who newly joined, can you demand the Diwali bonus? And in case it is not given, can you sue the company for it? Okay. All right. I got mixed answers. Okay. So Kaushiki, Panu, Purnima, Shriram, these people gave the right answers because it is not a contractual obligation. It is not a contractual obligation. What is the obligation which is created here? This is a constructive obligation. As Janvi Agarwal rightly mentioned, it is a constructive obligation. But unfortunately, when it is a constructive obligation, it cannot amount to a contractual one. See, you have created an expectation in the minds of the employees. किसने कहा था आपको एक्सपेक्टेशन क्रिएट करने के लिए? वो खुश थे ना बिना बोनस के. आदत किसने बिगाड़ दी? Who spoiled them? You spoiled them by making Diwali bonus payment every Diwali. I had to pay it to retain them, etc., etc. तो भुगतो अभी. Yes, so pay it off. The law did not tell you. Even in the appointment contract, there is no mention of Diwali bonus. You are paying it out of your own free will. And because you are paying it out of your own free will, nothing is contractual about it. Sir, it created expectation. Let it create. You will also pay because you created the expectation. I am going even one step further and saying you will make the payment of Diwali bonus every year. But that payment is not out of contractual obligation. That payment is out of a constructive obligation. And because it is out of a constructive obligation, it will be covered under Ind AS 37 and not under Ind AS 109 because there is no contract in the first place. For a financial asset and a liability to exist, there should be a contract. There should be a contract. If there is no contract, then there cannot be a financial asset or a financial liability. Okay. So this is a constructive obligation. You will make the payment in cash. but you cannot be sued if you do not. You make the payment because you are now afraid if you don't make, the employees will resign. And that is why you make the payment. That does not show that you have a contractual obligation. You have a constructive one. So take it to the standard which deals with constructive obligation. That is Ind AS 37. Here it is purely. So we've now come to a very, very small, narrow applicability of financial instruments. The narrowness being that it should be contractual. Today's takeaway from the session is that you can consider financial asset or a financial liability only if it is contractual. Only if it is contractual. Okay. So that is how it is. Okay. Sir, in case the company signed the contract, see, now you are saying if it signed a contract, it becomes a contractual obligation. Then the payment of Diwali bonus is definitely a financial liability. But yahan pe there is no contract. Appointment letters do not have that clause. Neither does it have a clause with the union. Kuch bhi nahi hai. Out of practice, you are paying it. You have like that. You would have read the news reports. Some employers in Surat ghar de dete hain. Okay. Mukesh Ambani gave a 22-storied flat to his employee of 40 years. Yes. वो कोई obligation थोड़े ही था. You cannot say that it amounts to an obligation for Mukesh Ambani. He gave it out of constructive obligation. He may have felt the need to pay it off. Okay. But that does not mean the obligation was sitting on top of his head. Yes. So therefore, when it is a constructive obligation, there cannot be a financial asset or a liability. So Sriram, absolutely right. Yes. Janvi, I hope you understood. Panu, Purnima, I hope you guys understood. Namrata understood. Yes. All right. So I hope everyone understood what it is all about. Okay, fine, fair enough. So that takes care of Diwali bonus also. All right. Now we come to the definition of hum abhi tak kuch bhi nahi padhe. To be honest with you, we have not yet started going into the depths of this definition only. Forget the standard. We are just stuck in the first two lines. Contractual obligation to receive cash or a financial asset. Contractual obligation to deliver cash or a financial asset. Hum log isi mein we are moving around in circles. Okay. We now take up the next definition, that is equity. I'll come back to financial asset and liability in a while. Okay. We now take the definition of equity. Equity's definition is very beautiful. Okay, one of the most beautiful definitions you'll come across. All the three, in fact. Okay, so your equity definition is very simple. It is a contract that evidences. Don't write this down. It is all there in the text. It is a contract that evidences residual interest in the assets of an entity after deducting its liabilities. Okay, so you can check here. What is a financial liability? ये सब बाद में आते हैं. Okay. It is a contract. तो यहाँ भी contract आ गया. Evidences a residual interest. This is important. In what? In the assets of an entity after deducting all of its liabilities. After deducting all of its liabilities. Okay. All right. Have they mentioned voting rights? No, they have not mentioned voting rights. Have they mentioned shares? Have they mentioned shares? No, neither voting rights hai, na shares hai, nor share capital, kuch bhi nahi hai. It could be something as simple as an item in the equity heading. which meets the requirement of an equity instrument. Okay, sir, हमने पढ़ा था ये? Yes, we have studied it. I think I only taught this batch Ind AS 102, right? And in Ind AS 102, if I remember, we had done group share-based payments. And in group share-based payments, if I remember correctly, we had discussed that employees of the subsidiary are working for the subsidiary, and in exchange they are getting shares of the parent. So when shares of the parent are given, the subsidiary will pass the entry crediting capital contribution from the parent. Subsidiary will debit employee benefit expenses. Parent will credit share capital. Debit क्या होगा? Well, you can say that the parent is investing. So investment in subsidiary. Subsidiary will say capital contribution from parent. Are they issuing shares? Answer is no. But will this money be repayable to the parent? Answer is no. Answer is no, it's not repayable. Parent ने बोला बेटा तू रख ले. Okay, मेरी तरफ से तोहफा समझ ले, तू रख ले. I don't want this money back. You are after all part of me only. So therefore, when this does not come back, is Reliance issuing its shares amount to making an investment in the subsidiary? Yes, it does. See, because it is increasing the investment base. But is it issuing share capital? Answer is no. Is the subsidiary issuing share capital? Answer is no. So therefore, if subsidiary is not issuing share capital, conventional thought process required me to say there is no shares only in this. But here the standard says this interest of Reliance in the entity without issuing shares of the subsidiary does amount to an equity interest being created in the subsidiary. And because it is creating an equity interest in the subsidiary, this interest can be returned back to Reliance only at the time of winding up of Jio. And not before that. It is merely investment. But investment in what? Investment in equity. But sir, Jio ने तो कुछ शेयर इश्यू नहीं किए. हाँ बेटा, तो डेफिनेशन में शेयर इश्यू कहाँ लिखा है? The beauty of these three definitions, financial asset, financial liability, and equity is, the beauty of these three instruments is that, of these three definitions is that, in none of the definition, they have mentioned the name of an instrument. None of the definition, they have mentioned the name of the instrument. Instead, what they have said, they have given the characteristics of the instrument. And then they said, if your instrument meets these characteristics, whatever be the name, that is irrelevant now. If it meets the features mentioned in the definition, then and then only it will be a financial asset or a financial liability or an equity. Sir, if it does not fall in these categories, it will still continue to be a liability or an asset, but it will not be a financial liability or a financial asset. Is it okay? So, you cannot say that ये तीन नहीं तो कुछ भी नहीं. अरे बेटा, ये तीन नहीं है तो definitely there will be other standards where it will be covered. जैसे अभी हमने देखा constructive obligation. Constructive obligation is not a financial liability because nothing contractual about it. But is it a liability? Answer absolutely yes. I give a thumbs up for that. It is an obligation. Under which Ind AS? It is an obligation under Ind AS 37. So therefore, anything which does not meet the criteria of financial asset or FL or equity does not mean it is not an asset or a liability. It is an asset. It is a liability. Only thing is, it will not be covered under the financial instruments standard. It will be covered under other standards. Is it okay? So when we talk about equity, it is an instrument that evidences what? Residual interest in the entity's assets after deducting all its liabilities. गोल चक्कर काटने के बाद sum total में what is that meaning? It is nothing but the residual interest in the net assets of the entity. Sir, net assets कैसे? assets minus liabilities क्या होता है? Net assets ही तो होता है. So therefore, it is the residual interest in the net assets of an entity. Sir, let us break this up further. You would have studied from the very beginning, equity shareholders at the time of company's liquidation will stand last in the queue. जो कुछ भी बचा कुचा रहेगा उनको मिलेगा. Have you studied this? Yes, you have studied this. This is exactly what is mentioned in this definition. It is evidencing a residual interest. Residual interest means whatever is left over after paying your preferential creditors, after paying statutory liabilities, after paying secured creditors, after paying preference shareholders. After that, what is left? If there is anything left, the equity shareholders are entitled for that. The equity shareholders are entitled for that. This is what you have studied. The same thing. Whatever is left, उसको हम लोग बोलते हैं in polished language residual interest. सब होने के बाद what is left is a residue. You have an interest in that. So it becomes a residual interest. In what? After deducting liabilities from the assets, net assets. So therefore, this does not mean only equity shares. It means any instrument that meets the criteria of having a residual interest in the net assets of an entity. Is it okay? Sir, do we need to write the definitions, etc. in the same manner? Answer is no, it's not. You can use your own language. You will be awarded for it suitably. Okay. So did you understand equity instrument? Did you understand equity instrument? Yes. Did you understand what is equity? You understood what is equity? Yes. Okay. All right. Now let us move on to the next part. So in equity instrument, you look at this definition. Is there anywhere a contractual obligation? Answer is no, which is why the standard gives further clarification. Only if both the conditions A and B are met below, it includes no contractual obligation. See, baki ka we will read it later on as we move on to discuss. No contractual obligation to deliver cash or another financial asset. Assets had a contractual obligation to receive cash. Financial assets, contractual obligation to receive cash or another financial asset. Financial liability, contractual obligation to deliver cash or another financial asset. Equity, there is no contractual obligation. There is no contractual obligation. Is it okay? Yes. So that takes care of equity. That takes care of financial asset, that takes care of financial liability. Till now, anybody has any doubts? Till now, anybody has any doubts? Please ask. Everyone. Okay. Everyone, please tell me. Any doubts, any difficulties? Because now we move back to the definition of financial asset. We will now be discussing something else relating to the asset, and then we will come back to the assets and liabilities for our understanding. Okay. So did you understand residual interest? Okay, fine. See, you are an unfortunate investor in Go First Airlines. Okay. Airline has filed for insolvency. Okay. What do you have? Equity shares. Okay. So Go First Airlines has 11,500 crores liabilities to outsiders. Okay. It has 11,500 crores liability to outsiders. Now, what is the problem? You own equity shares. When are you going to get something out of this company? Go First will have office spaces. It will have properties. It will have its own trucks, equipments, ground force. Okay. Everything is there with Go First. So it will have some assets. It will have some assets. Okay. Whatever be the assets, now, whatever be the assets doesn't matter. Okay. Now, you subtract the liabilities from the assets. That gives rise to net assets, which we call as the residue. Okay. For the purposes of this definition. See, all the liabilities will be met. So after meeting all the liabilities, if the figure is positive, this becomes residue. Bacha hua. It is these shareholders who are having interest in this residue. Yahi padhe ho na aap log. You have studied this only. Sach batao. Okay. Tell me honestly. Yes. This is what you know about equity shares. All the outsiders will be settled. From what? From liquidating the assets. And then if something is left, that something, who has the entitlement of that? That something goes to the equity shares. Is this what you have understood? Tell me first, is it now in sync with your understanding? Yes. Did you understand this? We call it net assets or remaining net assets. Okay. Because all the liabilities will be settled off. Okay. So Purnima and Sriram, please confirm. Yes. So any instrument, now it is not talking about equity shares per se. It is saying any instrument that evidences a residual interest, in the assets of the company after deducting all its liabilities. Any instrument that evidences a residual interest in the assets. The instrument evidences an interest in the assets after deducting liabilities. That means what? Net assets. So any instrument that ultimately shows the interest in the residue becomes equity. Naam pe mat jao. Don't go to the name. Let me give you an example. Suppose you did not have equity shares. Instead, you are having CCD. आपके पास इक्विटी शेयर नहीं है, आपके पास सीसीडी है. सीसीडी मीन्स कंपल्सरीली कन्वर्टिबल debentures of Go First. Okay. Compulsorily convertible debentures of Go First. I am asking you now. ध्यान से जवाब दो, सबको ही जवाब दो. Compulsorily convertible debentures, CCDs. Is it a financial liability? Is it a financial liability or is it an equity? Look at the definition of financial liability. It is a contractual obligation to deliver cash or another financial asset. In the case of compulsorily convertible debentures, are you under an obligation to deliver cash Are you under an obligation to deliver cash? Answer is no. You are not under an obligation to deliver cash. It is a compulsorily convertible debenture. It is a compulsorily convertible debenture. Look at the definition of a financial liability. To deliver cash. Are you under an obligation to deliver cash? Answer is no. Are you under a contractual obligation to deliver financial asset? You will be tempted to say yes. You will be tempted to say yes because you are delivering equity instruments. That is what you will tell. You will say, I am delivering equity instruments and therefore it is a financial asset. But look at the definition of financial asset. It is going to be an asset if it is equity instrument of another entity. If it is equity instrument of another entity. In this case, Go First has issued compulsorily convertible debentures, and at the time of conversion, will it give cash? No, it will give equity instruments. Whose equity instruments? It will give its own equity instruments. It will not give cash. Own equity instruments cannot be financial asset. So therefore, there is no contractual obligation to deliver cash or financial assets. And therefore, will it be a financial liability? Answer is no, it won't. What will it be? You are delivering your own equity instruments, and therefore, naam bhale hi debenture ho, doesn't matter. Doesn't matter if the name is debenture, it will still be classified as an equity because it is a compulsorily convertible debenture. Because it is a compulsorily convertible debenture. Have you understood? Those of you who said that it is a financial liability, understand the definition. Beta, ye definition is like the heart of the standard. Okay, don't go out of the four corners of this definition. It is a very, very beautiful definition. Okay. A contractual obligation to deliver cash. Are you deliver is will Go First pay cash for these debentures? Go First will say कहाँ हम तो शेयर इश्यू करेंगे इसके लिए. So obligation to deliver cash तो है ही नहीं. अच्छा, will I have obligation to deliver financial asset? तो look at the definition of financial asset. Financial asset क्या बोलता है? Financial asset is cash or equity instruments of other entity. Other entity. The instruments are issued by Go First. Go First will not deliver equity instruments of another entity. Conversion के टाइम पे खुद का शेयर देगा वो. It will give its own shares, and therefore own shares cannot be financial asset. So there is no obligation to deliver cash. There is no obligation to deliver financial asset. So ultimately this becomes what? This becomes an equity. Where will you present it? Will you present it under liabilities? Answer is no. Yet another radical change. Preference share इतने साल तक शेयर कैपिटल में दिखाते थे. Now you will have to show it under liability. Compulsorily convertible debenture. नाम के हिसाब से till we used to go on the name, on the legal form, and as per the legal form we would show it as a liability because it was a debenture. But now Ind AS tells us ये तो debenture का एक भी feature नहीं है इसमें. Neither are you giving cash nor are you giving another financial asset. तो कौन सा liability हो गया? This is not a liability. This is an equity which you are holding. Don't show it under liability. Go and show it under equity. Ultimately, against these debentures, आपको कोरा कागज मिलेगा equity का. You will get equity. उससे क्या करोगे? कुछ नहीं कर सकते. Because company has gone into liquidation, you will ultimately also have a residual interest. In what? In the net assets of the entity. You are holding debentures, but those debentures are not financial liabilities. Those debentures are in fact equity because they are convertible into equity. No obligation to pay cash, no obligation to issue financial assets. It is equity. It is having a residual interest. तो नाम कुछ भी हो, whatever be the name of the instrument, look at the features. Look at the features. recollect the definition of financial assets, financial liabilities. Equity is, if it is not an FA, not an FL, it will be equity. Okay, you can kind of remember it like that. Okay, because if you see the text of the standard, what is it saying? If you read further, there should be no obligation to deliver cash, no contractual obligation to deliver cash. Okay, so if that is the case, then CCDs, though they are debentures, will be classified as equity, and you will be treating it as what you can say, an instrument with residual interest. So you can see in example of equity, other instruments convertible into fixed number of equity shares. So ये हो गया ना CCD. This is a compulsorily convertible debenture. Okay, is it okay? Yes. Are we clear about residual interest? Are we clear about residual interest, everyone? And do you have residual interest, or are you having lot of interest in the topic? Okay, two questions. Are you clear about residual interest? And the second question is your interest in the residual part, or are you having interest in the session? Okay. Okay, great, great. It's already 9. My God. Okay, fine. Okay, so we take a 5-minute break. Okay, we take a 5-minute break. Process yourself. Okay, please come back, because now I am discussing the more important part of the topic. Okay, of the definition. हम अभी तक definition में ही अटके पड़े. Okay, so the more important part of the definition will follow after the break. Don't go anywhere else. Okay, so take a 5-minute break. All right. Welcome back. So, Namrata, I will be able to address the query that you have. Maybe not today, but in the next class, you only will be clear with the discussion. Okay. It will be clear. Don't worry. Okay. So that is a very important topic which we will be discussing. Okay. So now coming back to our definition. So we are clear with the first part, only the first part of the definition. Let us then move on to some discussion on derivatives. Okay. Let us move on to some discussion on derivatives. Okay. Are derivatives financial instruments? What do you guys think? Are you familiar with derivatives? Little bit, somewhat, thoda sa, or not at all? I just need to know your degree of comfort with derivatives. Okay. Are you familiar with derivatives? Okay. All right. So Janvi said yes. Okay. Okay. So somebody says no idea at all. Okay, fine. Okay. So derivative, these are instruments. First thing, or contracts. Okay, fine. Now these instruments or contracts, derivative, that means they derive value. These instruments or contracts, they derive value. It's there in the word itself. From what? The value for these contracts comes from where? From where do they derive value? What gives them the value? They derive the value from an underlying. From an underlying. Okay. तो इसको हम लोग बोलते हैं derivative. We call this as a derivative. A contract that derives its value from an underlying. It could be an asset, whatever it is. We will see that right now. Okay. तो इसको हम लोग बोलते हैं derivative. By itself, derivative has no value at all. If you look in isolation, the contract has no value at all. But when you look at it with the price movement of the underlying, and the price movement of the underlying will then start to give a value to this contract or to this instrument. Let us take with the help of an example. Okay. Okay. Suppose today's rate is $1 equals rupees 82, or I'll make it 80, round figure. Okay. Today's rate is $1 is rupees 80. Okay. You have an export obligation, an import obligation that is going to come up in the next 3 months. Okay. In the next 3 months, you have to pay an import bill of say $1,000. Okay. So you have to make the payment. Now, this is foreign currency. तो अपने देश में अपने करेंसी का अपने पता नहीं रहता है. फॉरेन करेंसी का क्या इंपैक्ट होगा भाई अपने को क्या मालूम. I don't know. Okay. Times are very unstable. Okay. Unstable. You have the Russia-Ukraine war. You have the US-China cold war that happens. Okay. So I'm very uncertain. Okay. Somewhere you have the dollar payments increasing. Somewhere you have reliance on the Russian ruble and the Chinese yuan and the Japanese yen increasing. There are too many factors for a poor, small importer like me. So what I do is I am not sure what is going to happen to the dollar price in the future. But in the past couple of months, I have noticed that the dollar price goes on increasing, So let us suppose that I have the import obligation to be met within the next couple of months, within 6 months. So what I do is, भाई मेरे को safe position चाहिए. I need a safe position. So today itself, I will go to the bank and enter into something known as a forward contract. Enter into something known as a forward contract. What is a forward contract? This is a contract where you are entering to purchase $1,000 at rupees 80 per dollar. At rupees 80 per dollar after 6 months. On today's date. So on, let us say it is 1st May 2023. This is the contract that you are entering into. This is the contract that you are entering into. Now, the question is it a derivative or not? Okay, this is the first question that you have to understand. All derivatives have three features. All derivatives will have three features. Sir, what are the three features? This is common with all types of derivatives. Okay. The first feature is it derives value from an underlying asset. Okay. So in this case, this piece of paper by itself, will it have any value? Answer is no. It will have a value when the underlying asset changes in terms of value. Okay. Changes means what, sir? Changes means when the dollar moves, at that point of time, your paper is going to have a value. At that point of time, your paper is going to have a value. Let us assume that 1 month later, on 1st June 2023, the exchange rate moves as 85 rupees per dollar. Exchange rate moves as 85 rupees per dollar. That means, understand, if you had to purchase the dollars from the open market today, you would have to pay 85 rupees. But because of this contract, you can get the dollars at 80 rupees. You can get the dollars at 80 rupees. So in this contract, you have a contract to purchase dollars. So your underlying asset is $1,000. You have the underlying asset as the $1,000 that you are seeking to purchase. So that becomes your underlying asset. Dollar becomes your underlying asset. Okay. It could be dollar. It could be currency. It could be gold also. We are seeing the crazy gold price rising. Okay. So think of a company like Tanishq or Malabar Gold or whatever, that Kalyan Jewelers or whoever it is. Think about the huge amount of increase they would have to bear on account of this sudden increase in gold price. It's running about 60 to 63,000 per 10 grams right now. Okay. Just a couple of months back, it was somewhere in 55, 56 is what I remember. Just imagine, it's a crazy thing that these people have to bear if they do not indemnify themselves. So what they would be doing is they would be entering into a forward contract with the gold suppliers to purchase certain quantities of gold for a certain price to be settled in the future. So it could not only be currency. In this case, the forward contract would have the underlying asset as gold. You look at the basic asset which you seek to buy, usko hum log bolte underlying asset. The derivative contract sits on top of that. The derivative contract sits on top of that. So it works like the underlying will start moving in a particular direction, but your price which you have contracted to enter, that price remains fixed for you. That price remains fixed for you. Sir, ulta bhi ho sakta hai, definitely ho sakta hai. Instead of 85, your liability, your dollar can be 78 per dollar. In this case, your forward contract could have a negative value right now. Your forward contract, see, because market में जाओगे 78 rupees, but आज के तारीख में you have entered into a contract for 80 rupees. That means your contract is having a loss of 2 rupees per dollar, is having a loss of 2 rupees per dollar. Suppose कल को उठ के on 6 months na, on 1st November 2023, if the value of the dollar is 74 rupees, then what you have to do? अरे आपको झक मार के 80 rupees पे खरीदना पड़ेगा, because you are having 80 rupees contracted price for this dollar. सर मैं क्या करूंगा? I will sell this to somebody in the third market. मैं ये contract किसी को बेच दूंगा. If you have to sell this contract to somebody, that somebody is not a fool to buy this contract from you free of cost. क्या बोलेगा वो? सबसे पहले you pay me 6 rupees. Why 6 rupees? अरे I will buy the dollar easily from 74. मैं तो तेरे पे एहसान कर रहा हूं तेरा कॉन्ट्रैक्ट लेके, उसके बदले में you pay me 6 rupees per dollar and then I will procure a 74 rupees and therefore the contract becomes 80 rupees per dollar. So therefore the value of this contract changes according to the value of the underlying, changes in accordance with the value of the underlying. Okay, so usko hum log bolte underlying asset. If I replace this currency with gold, if I replace this currency with gold instead of dollars, then the underlying asset becomes gold. If I replace it with wheat commodity, wheat, gehu, if I replace it with wheat, it becomes a wheat forward contract. Can I replace it with shares? Yes, I can replace it with shares also. So all these are my assets. I want to buy them, but I want to be protected against the future price movements. So therefore, today itself, I am entering into a contract which fixes the price, the date of the settlement right today. Okay, so this is the meaning of underlying. कुछ भी हो सकता है. Right now I am taking the example of a currency. Okay, so now the currency forward contract, which why we call it as forward, it will be settled in the forward, in the future, it will be settled ahead after some time. Okay, तो इसके लिए हम लोग बोलते हैं forward contract, FORWARD. Okay, now suppose on 1st of May, the market value is 80. Your contracted price is also 80. Your contracted price is also 80. You tell me now, you tell me, will this contract today, that is on 1st May, I need you to just focus on this, because this is going to create problem if you don't follow. Today the date is 1st of May. Today the spot rate is 80 and the forward rate is also 80. Nahi hota hai, but I'm just taking the case. Okay. You tell me on 1st of May, will your forward contract have any value? ध्यान से जवाब देना मुझे. Will your forward contract have any value? See, forward contract derives value from underlying. So underlying का value तो 80 ही है. Forward contract also is entered for 80. Now you tell me, will your forward contract today have any value, or is it going to be zero? Is it going to be zero? सोच के जवाब देना. No value, as there is no profit or loss. Absolutely. See, you are an importer, you need $1,000. Okay, you go to somebody like you who is an importer who needs dollars, and then you tell, देख बेटा, I have this forward contract, but I want to sell it off. मेरे को ये forward contract नहीं चाहिए अब, तो ये forward contract ले ले. Okay, so forward contract, तो you will transfer it to him. Since you are transferring something, बदले में कुछ आना चाहिए ना, something should come to you. क्या आएगा? वो बोले क्या दू, आज के रेट तो है ये, why should I transfer anything to you? So today's date, the value of this contract is zero. There is no value because the price that you have entered into and the spot rate is exactly the same. So today's date, this contract has no value at all. Okay. However, on 1st of June, the currency moves to 85 rupees per dollar. And then you find that मेरे को ये obligation नहीं चाहिए, I want to sell this contract. If you are entering into that sale, then you look at this particular scenario. Outside market, the dollar is available at 85. You have a contract to purchase the dollars at 80. Answer my question carefully. Is your contract valuable or has it lost value? Okay. Did it gain value or did it lose value? When the market price of the dollar moved from 80 to 85, your price is fixed at 80. So now you tell me, this piece of paper, this contract which you're having, will it become valuable or is it going to lose the value? What do you think? सोच समझ कर जवाब दो. Okay. It is going to gain the value. It is going to gain the value. Definitely. See, आज के तारीख में the price is 85. So in the future, you foresee an upward trend. So against an upward trend, you have frozen your price at 80 rupees per dollar. That means definitely your contract has a value, and that value is roughly rupees 5 per dollar. It's not so simple, but just for the purposes of our understanding, you will be discussing this in detail in SFM. Okay. I don't call myself a great expert in derivatives. Okay. But anyways, thoda bahut samajh mein aata hai. See, when the market price moves to 85, will the contract that you are holding, the forward contract, will this forward contract gain the value when the spot rate increases to 85, or will it lose the value? Suppose on 1st of June, you want to sell this contract. You will go to somebody and say, देख बेटा मेरे पास ये contract है, I think you are in need of dollars. तो मेरे को dollar नहीं चाहिए अब, because I am getting another export receivable around the same time as my import. So that cash flow will settle off my obligation, but I had taken this forward contract. तो रख ले चाहिए तो if you want. तो बोलेगा, he will look at the contract, he will say 80 rupees. यार आज तो 85 है. तो बोलेगा मैं फ्री में रख लूं. You will say, काहे का फ्री? Why should I give it to you for free? Today, I have to purchase the dollar for 80 rupees as per the contract. Market में जाऊंगा 85 है. You have not entered into the contract, na? I have entered. So therefore, you pay me 5 rupees and then in the future date, you settle with the bank at 80. So for him, he is going to pay 85 only. Only thing is that 85 will be split between 5 rupees to me for the forward contract and 80 rupees to the bank for settling the obligation. Okay. So therefore, 85 price movement hota hai, then the forward contract price also starts to move. Then the forward contract price also starts to move. Okay. So in the derivative, the first future is, it could be currency, it could be gold, it could be oil, it could be shares, anything. Derivative का अपना value नहीं होता है. The contract does not have its own value. The contract derives the value from an underlying asset. The contract derives the value from the underlying asset. You look at currency. Is currency a derivative? Answer is no. Currency has its own value. Is gold a derivative? Answer is no. Gold forward is a derivative. Gold future is a derivative. Gold options is a derivative. But gold in itself has a value. and therefore gold cannot be a derivative. Gold is a commodity. Likewise, wheat. Is it a commodity? Yes. Does it have value? Yes. So it cannot be a derivative. But this contract, apne aap mein, does it have a value? Answer is no, it doesn't. And because it doesn't have a value, is contract ka value kahan se aata hai? The value comes from the underlying asset. It could be a contract to buy dollars. It could be a contract to sell dollars, whatever it is. Okay. But you are having a contract whose value depends on the movement of the asset for which you have taken the contract in the first place. तो इसको हम लोग बोलते हैं derivative. The first feature derives value from the underlying asset. The second feature of a derivative, second feature, settlement happens at a future date. At a future date. Okay. It could be some weeks, it could be some days, it could be some months, it could be. So that is what the settlement will happen. Today, when I go to my bank and enter into a forward contract, I don't have to pay 80 into 1000, 80,000 today. Bank bolega, nahi, aaj mat pay karo. You pay me after 6 months only when you need the dollars. Today we have just frozen the rate. तो इसको हम लोग बोलते हैं forward contract. We call this as a forward contract where I am freezing the price today itself. So there is a value from the underlying asset. Settlement happens at a future date and initial amount paid. Initial amount paid will be nil, or it could be what we call insignificant as compared to the contract price. It will be insignificant as compared to the contract price. So derivatives ke case mein, these three things will always be there. These three things will always be there. Okay. Derives value from an underlying asset. Settlement happens at a future date. Let me just add here, at a future date at an agreed price. Okay. At an agreed price. In our case, the agreed price was how much? 80 rupees per dollar. And initially, you will not pay anything, or you will pay a very insignificant amount. You will pay a very insignificant amount. Are you clear with the features of derivatives? Are you clear with the features of derivatives? Yes or no? Are you clear with the features of derivatives? Yes. So since I have entered this into a contract for procuring foreign currency, it becomes a currency forward contract. If it is gold, for procuring gold, gold forward, wheat forward, equity forward contract. Depending on what is the underlying asset, the derivative name will accordingly get the name of the derivative will accordingly change. Okay. So this is a forward contract. A contract, will come to that. I'm coming to that. Okay, Janvi, just hold. See the problem. I mean, the moment we start discussing about derivatives, all students' minds are also flushed with questions. Derivative क्या होता है? हमने कभी देखा नहीं, अपने को कभी मालूम नहीं. Relax. Options भी आएंगे, forward भी आएंगे. We will pick it up one by one. Okay. So now let us move on to another type of contract. Forward contract का बड़ा भाई है. Forward contract, elder brother of forward contract. We call it as a futures contract. Okay. Okay. What is a futures contract? It is same like a forward contract. तो फिर नाम अलग क्यों है sir? Forward contract is customized, over the counter contract. Future contract is through an exchange. Futures contract is through an exchange. So I am having, sir फिर से बताइए ना क्या होता है forward futures. आप बोलते हो दोनों सेम है. In terms of the contract, it is the same. In terms of the contract, it is the same. But there are some differences. Okay. In terms of the essential features, it's exactly the same. Okay. First one, what is the common feature? It is a contract to buy or sell a particular underlying asset at a predetermined price, at a predetermined future date. तो buy sell हो सकता है किसका? Underlying asset, predetermined price at a future agreed date. All the four. Basically, you are removing all the variability that could surround this transaction in the future. All the uncertainty you are removing, you are eliminating. Now let us move on to the features between forward and futures. What is not common? Okay. Forward contracts are over the counter contracts. Over the counter contracts. Okay. Over the counter matlab kya? If you want to buy $1,000, you go straight away to the bank, counter pe jao. That is why we call over the counter. You go to the bank, tell them I need $1,000 after 6 months. मेरे को forward rate बताओ. He will give you the forward rate and then बस लेकर आने का contract. Okay. So this is over the counter contract. Whereas futures क्या होता है? You cannot go to the bank. Okay. अगर if you want to purchase futures, then this will be exchange traded. Exchange traded समझते हो? Exchange traded contracts, like you have the stock exchange, National Stock Exchange, Bombay Stock Exchange. These, the shares that you are buying and selling, we call them as exchange traded shares or exchange traded securities. Similarly, these are exchange traded contracts. Okay. So that is the biggest difference. Okay. Now, iske baad whatever happens is a consequence of this feature. Okay, matlab kya? Any difference after this is because of the fact that one is over the counter, other is exchange traded. Sir, aage bataiye. Second, a forward contract will be customized. Will be customized. You need $1,000, we'll give you a contract for $1,000. You need $995.5, we will give you $995.5. You need $1,084.25, you will get $1,084.25. So this is a customized contract. This is a customized contract. Whereas exchange contracts are standardized. Exchange contracts are standardized. Standardized means what? It is available in, say, lots of $1,000. It is available in lots of $1,000. तो क्या करना पड़ेगा अपने को? If I have exposure of 995.5, I cannot go to the exchange and say, give me a currency future contract of 995.5. वो बोलेगा बेसिक प्राइस 1000 है, 1000 लेना है तो लो, नहीं तो निकलो यहां से. ओके. अच्छा, तो क्या करोगे? इट इज नॉट कस्टमाइज ना, इट इज स्टैंडर्डाइज. सो यू विल बाय 1000. ओके. व्हाट अबाउट द अदर साइड? सर, आई हैव एन ऑब्लिगेशन ऑफ 1084.85. आई वांट अ कॉन्ट्रैक्ट ऑफ 1084. तो वो बोलेगा नहीं है अपने पास सिर्फ 1000 है. सो यू विल बी वरीड that it is $84. Okay, let us increase it. Suppose you have $1,700 ka obligation. The futures contract is available in lots of 1000. So what you can do is you buy one future contract of $1,000 and $700 will be hedged, will be exposed, or you can buy two contracts of $1,000, in which case your risk is entirely protected. Additionally, $300 you will be having a cash outflow, which you can settle it later on once you get the dollars. Dollars तो आपके हाथ में रहते हैं ना. So therefore, it is like an asset which you are having, but you will have a cash flow issue in the future. So therefore, you cannot customize these contracts. They are standardized. Okay. If you want to protect this amount of 700, then you buy two contracts. That means you are having excess $300 with you, for which you will have to pay cash. There is no other option left for you. There is no other option that is left for you. Is it okay? So customized standardized. This is the first feature. Second feature, okay. Third, same, buyer seller deal directly in a forward contract. Deal directly matlab kya? You go to HDFC Bank and then you say that I want to buy a forward contract for $1,700. So HDFC knows who is buying, you know who is selling. Matlab buyer seller identities are known to each other. So that is what is meaning by transaction dealt with directly by the buyers and the sellers. However, in an exchange traded contract, the buyer will come to the exchange and say, mere ko 2 contracts of $1,000 each de do. Who is selling? I do not know. I do not know who is selling. The one who is selling doesn't know who is buying. So both the sides it is. Okay. You can take the exchange something like this. EXCHANGE. Okay. Exchange. On one side you have the buyer. On other side, you have the seller. The seller will place the contracts on the exchange. The buyer will buy the contracts from the exchange. But buyer ko seller kaun hai, uska shakal kya, kuch pata nahi. Neither is the seller aware of who is the buyer. For the seller, the exchange is the buyer. For the buyer, exchange is the seller. This is exactly how National Stock Exchange operates, how the Bombay Stock Exchange operates. So, what is the advantage of an exchange traded contract is tomorrow, suppose you enter into the contract to buy 2 contracts of $1,000 each, but in the future, you do not want it. If you don't want it, क्या करना पड़ेगा आपको? You just go to the exchange and sell off that contract. Exchange will buy it from you because exchange is having sellers on the other end also. So therefore, you will not have any problem in selling off your contract. But in the case of forward, further selling off becomes very difficult. Why? Because आपको दर भटकना पड़ेगा. You have to go to nook and corner to find somebody who is willing to buy this contract from you. Bank will not buy it back from you. Bank बोलेगा you entered into the contract. So now why should I breach the contract? You have to honor the contract. So therefore, bank will not buy it from you. You have to take that contract and go on roaming until you get a buyer. But futures में ऐसा नहीं होता है. Futures में you want to rescind the contract, sell the contract. All you have to do is go to the exchange, place the contract on the exchange. Exchange will buy the contract from you and pay the compensation that is due to you. Okay. Is it okay? Are you able to understand forward versus futures? Yes. So crudely speaking, forward contract is like an unlisted share, jahan pe you will not find buyers. Okay. Whereas futures contract is like a listed share. Okay. It is freely tradable on an exchange. So this is a forward contract and that is a future contract. You have both the discussions done. Basically, in a forward contract, okay, the last point of difference is, no margin money. No margin money requirements. Okay. No margin money. कुछ नहीं करना है आपको, खाली ये लेकर चलना पड़ेगा. You will always have to pay it at the time of settlement. कुछ margin money नहीं. Whereas here you will have to pay some margin money. Margin money क्या रहता है? It will be a small amount. यार. See, if you are procuring 2 lots of $1,000, it may be something like 1,000, 1,500, whatever it is. It is very small, very insignificant, but basically it is to establish your commitment to the transaction. You are collecting the margin money to establish your commitment to the transaction. Kal ko aapne exchange pe you have put in your contract and then you are not traceable thereafter, then how it is possible? Na? So therefore, margin money is to ensure that you honor the contract in the future. But whatever, whether it is forward or futures contract, the features remain the same. Is it deriving the value from an underlying asset? Yes. In our example, dollars, it could be equity, it could be currency, it could be wheat, it could be gold, it could be commodity, any asset for which there is an exchange or a forward that is available. Second, settlement happens at a future date. In our example, also at a future date. Initial amount paid will be nil or insignificant. So we saw that for a forward contract, no initial margin, whereas for an exchange contract, you will have a margin that you will have to pay. Is it okay? Yes. Forwards and futures समझा अपने को? Yes. Yes. Mrs. Purnima, did you follow? Yes, that's right, Kaushiki. Futures contract has marketability as well as liquidity. That's right. Okay. What about the others? Namrata, did you follow? Viraj, did you follow? Shriram, did you follow? Janvi, ko to she said she is okay with derivatives. What about Panu? What about Viraj? Did you follow forwards versus futures? Underlying asset I have explained. Okay, fine. Now you have a third contract which Janvi had already asked, and that is something known as options contract. There is no limit to greed. Okay, लालच का कोई एंड नहीं है. हम फॉरवर्ड और फ्यूचर से खुश नहीं थे. हम सोच रहे थे सर आगे चल के इन द फ्यूचर इफ द प्राइस goes against me, if the price goes against me, means what? Suppose you have purchased a forward contract when the rate was rupees 80 per dollar. You purchased the contract thinking that the rate will go up in the future. But then what you are noticing is first month it came to 79, then it came to 77, then it came to 76, then it came to 75. Now you are starting to feel अंदर ही अंदर से आप you are what you can say from inside only you are getting sad and depressed. यार काश मैं contract न लिया होता. I just hope I had not taken the forward contract. Then I would have been able to procure the dollars at 75 rupees per dollar instead of 80 rupees, which is my contracted price. So therefore, that is what you are going to be worried about. So therefore, there is a third contract. There is a third contract, which is known as an option contract. Which is known as an option contract. Option contract में क्या होता है? You have the option to exercise the contract or not to exercise the contract. Sir, matlab, see, today's date, I have an option, not an obligation. It is not an obligation. It is an option. You have an option to procure the dollar at 80 rupees. You have an option to procure a dollar. How many dollars? $1,000. You have an option to procure $1,000 at 80 rupees per dollar. ठीक है, ये कॉन्ट्रैक्ट लेकर हम घर आ गए और घर में बैठ गए. Now, suppose the price of the dollar goes to 95 rupees. I'm taking such exorbitant rates so that you can understand better. Suppose the price of the dollar goes to 95 rupees per dollar. क्या करोगे तुम? You tell me. Suppose if the price of the dollar goes to 95, you have the option to buy dollars. Okay. So now you tell me, if the market price is 95, your option to buy is 80 rupees. What are you going to do? Will you exercise the option or will you remain quiet? You will. Come on, everyone tell me. Will you exercise the option or will you just keep quiet and do nothing? Bolo yaar. Kaushiki, right? What about the others? You will exercise the option. It depends whether you resell or you use that to pay your other obligation. The choice is yours. It's not necessary that you resell. Okay. So everybody said exercise the option. Very good. But suppose the dollar falls to rupees 60. I'm taking a very large movement so that you can appreciate the fact. Okay. Now tell me 80 rupees pay, you have agreed to buy. You have agreed to buy, but the price has fallen to 60 rupees per dollar. अब बोलो कॉन्ट्रैक्ट का आप क्या करोगे? What are you going to do with that contract? Are you going to exercise the option if it falls to 60 rupees, or are you going to remain quiet? Don't do anything. Yes. Yes. Sriram is right. Kaushiki is right. So that is the benefit of an options contract. Okay. That is the benefit of an options contract. If the price falls to 60, you will not exercise the option. आप बोलोगे यार मैं option exercise क्यों? Why should I exercise the option? I'll go to the market and buy the dollars at 60 per dollar, at 60 rupees per dollar. I will not exercise this option. I will not exercise this option. So therefore, an options contract has what we call an unlimited upside. Theoretically, it has an unlimited upside. Matlab, whatever be the price of your dollar, it may be 95, it may be 950, 9,000 per rupee, whatever it, 9,000 rupees per dollar, whatever it is. Okay. But for you, it will be fixed at 80. So unlimited upside is possible, but downside is zero. Downside is zero. अगर वो 30 rupees per dollar हो गया, I'll not exercise only. मैं बोलेगा I'll buy from the market. Why should I buy from this option when I have to pay 80 rupees per dollar? I'll not exercise that option. Is it okay? Yes. तो इसको हम लोग बोलते हैं options. Now the problem is, देखो forward contract में settlement had to happen. Futures contract settlement had to happen. Futures options is a futures option settlement would happen. The problem is options contract. If you are buying the option, somebody has to sell the option. If you are buying the option, somebody has to sell the option. ना आप market में अकेले option खरीदा नहीं बोल सकते. If you have bought, somebody has sold that option. The issue is, if somebody sells that option, why would he sell that option to you? Why would he sell that option to you? And what is his compensation for selling that option? Are you able to appreciate? He's not only selling, he's selling something jahan pe there is a one-sided gain. See, the option writer usko bolte hai. Option writer or option seller is selling the option to somebody who will exercise only if there is a gain. Are you able to follow? So somebody is selling the option to somebody who will exercise only if there is a gain. If there is a gain for the buyer, it is but obvious that there will always be a loss for the seller. Are you able to follow? Yes or no? See, आपको कैसे मालूम? सीधी सी बात है ना? See, in this case, 80 and 95. If you go to exercise this option, what are you going to do? You are going to pay this fellow 80 rupees के हिसाब से you will pay and you will pay him 80 rupees and get $1,000. But for this fellow to get $1,000, he should first have $1,000 ना. तो कहां से लाएगा? He will buy it from the market. कौन से rate पे लाएगा? He will buy it at 95. So if it is a gain for you to exercise, it will be a loss for him to have exercised the contract. Are you able to follow this? Yes. Are you able to follow this or not? Bolo yaar. Please tell me. Are you able to follow? If it is a win situation for you, it is a loss situation for him. Are you able to understand this? Yes. Yes. Options is a feel-free contract. Absolutely. For the option holder. For the option holder. Please tell me, every time an options contract results in a gain for the holder, does it mean that it results in a loss for the writer or the seller? Answer is yes. It does. It does. Okay, so that is why the option writer will seek some compensation. तो उसके लिए we pay him a premium. Okay, we pay him something known as an option premium. It will not be the size of the order value. It will not be the size of the order value. It will be small only. But again, coming back to our features, is the option deriving value from the underlying asset? Answer is yes. Is the settlement happening at a future date? Answer is yes. Initial amount paid could be nil or insignificant. Answer is yes. So is an option contract a derivative? Answer is yes. And now coming back to our options discussion, options will be exercised only when it is a win situation for the option holder, which will result in which will result in a loss situation for the option seller, or the option writer. Okay, so that is the next part of this. So when it is a win situation, can I say that under situations potentially favorable? Yes or no? Can I say that it is a scenario which is potentially favorable because he is getting dollars at 80 as against 95? So is it potentially favorable for the buyer? Answer is yes. If it is potentially favorable for the buyer, can I say that it is potentially unfavorable for the seller? Can I say this? It is potentially unfavorable for the seller? Obviously it is. So potentially favorable, potentially unfavorable. And then if you see the definition here, what I want you to do is read this. This should give you clarity now. A contractual obligation to exchange financial assets. In the currency contract, the option seller would get rupees and give dollars. Are both of them currency? Yes. It's not saying foreign currency nahi kar sakte. You are exchanging financial assets or liabilities, देखेंगे हम, with another entity under conditions that are potentially unfavorable to the entity. Are you able to follow? तो ये किस instrument के बारे में बात कर रहा है? This is talking specifically about an options contract. And this is from the perspective of the option seller or option writer. This is from the perspective of an option seller or an option writer. अभी आप मुझे बताओ, the contractual financial asset का wording क्या होगा? What will be the financial asset का heading? It will be a contractual right. To exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. So therefore, we have completed the second part of our definition, that is to exchange financial assets or liabilities with another entity under conditions that are potentially favorable, to the entity. Is it okay? Have you understood? Yes. So this is again an option contract where it is favorable to the option buyer. Is it okay? अरे समझ में आया अपने को? बोलो यार. Options contract, did you follow? Yes. So basically option contract में क्या? आप महाराज हो. You are the king. Upside में उड़ो हवा में, downside में कुछ मत करो. You will not fall to the ground. You are the king of the contract that you have entered into. Is it okay? Yes. All clear so far? Understood? Kaushiki, did you follow? Janvi, Did you follow? Viraj, Panu, did you guys follow? Yes. Anybody has any doubts? I still have not completed the definition. Don't worry, we'll be taking it up in the next session. But right now I have only taken that part for us to understand. Okay. I took the options. I had to take you through the derivatives discussion. So then the next session, when we do the examples, you will be able to understand. Okay. So anybody has any doubt in today's session? Anybody has any doubt in today's session? Please ask. Any doubt? Any doubt? No doubts? Okay, all clear. Then we shall meet on the 16th. What? No, I'll not give you any homework. Shanti se ye lecture just sun lo if you can, or just go through those 2 to 3 lines which we have discussed, where you know that contractual right, obligation, just go through that and come. Okay, homework dene layak to kuch tha bhi nahi, but kyunki we have not even completed the definition of any of the instruments. Okay, but it's fine. It will be a little heavy. I don't discount that. Okay. But let me tell you that you will start to enjoy the topic once we complete this theory and we move on to the questions. It's a very, very enjoyable topic. Okay. So that's it then for today. See you guys on 16th now. Yes. See you guys on 16th. And just go through the topic in brief. ज़्यादा दिमाग अभी आज के लिए मत लगाओ, because I have not yet done anything for you. Okay, it's just been the initial session जहां पे हमने discussion किया था. So take care. See you guys on 16th. We'll cover up more of it. Okay. Thank you everyone.